Hello, I'm John AG, and before we talk about charts, prices, or explanations, I want you to notice what just happened inside your own head over the last couple of weeks. One moment you felt steady, the next moment you felt unsettled, not because the world changed overnight, but because a screen flickered the wrong color and a story arrived right on time to explain it. That emotional shift is the real market event. Price is just the messenger. And when gold and silver were whipped violently in both directions, tagged with an ugly low late last week, and then wrapped neatly in a central bank storyline, what mattered most wasn't the explanation. It was what the market was trying to make you believe. I wasn't planning to record this. I was in the middle of an ordinary day, doing ordinary things, until I watched the tape more carefully and realized something felt engineered, not manipulated in a dramatic sense, but framed. The loudest voices were offering a convenient narrative, one that asked you to stop thinking and accept the conclusion. And if you're holding metals or even considering it, you deserve more than a headline that arrived after the move already happened. Over the past 2 weeks, gold and silver were pushed lower, snapped upward, then shoved again, with Friday marking a particularly sharp flush before buyers showed up. The popular explanation pins the entire episode on expectations, tone, and personalities. That explanation is clean. It's also incomplete. Markets rarely move because of one idea. They move when positioning becomes crowded and liquidity disappears in the wrong places at the wrong time. Narratives don't cause the move. They justify it afterwards so people feel oriented again. Here's what happens in stretches like this. When prices rise, attention follows, confidence expands, and risk feels intelligent. When prices fall, attention follows fear, confidence collapses, and the same positions suddenly feel foolish. The market doesn't just move price during these periods, it moves perception. And the participants who consistently survive aren't predicting the next candle, they're managing their reactions. Volatility is not chaos, it's information. It tells you where pressure is building and where positioning is vulnerable. When you hear that metals have been volatile, translate that into mechanics. Thin liquidity, leverage being forced out, stops triggering automatically. Headlines acting as steering wheels rather than explanations. None of this implies wrongdoing. It implies structure. You can be smart and still get shaken out if your position size doesn't match your time horizon. Metals magnify this problem because they don't behave like equities. Stocks trade evolving stories, earnings, growth, leadership, scandal. Gold trades something much older. Gold trades trust. Gold doesn't need a new reason every week, it needs the old reason to remain intact. That reason isn't aesthetics or nostalgia. It's the historical reality that paper promises eventually stretch beyond comfort. That reality doesn't vanish because of a volatile fortnight. It gets tested. There's a simple mental filter that cuts through noise in any market. When price moves emotionally, ask whether reality changed or positioning changed. Reality shifts slowly. Positioning can flip in hours. Over the last 2 weeks, what we've seen looks far more like positioning stress than a fundamental reversal. Momentum chasers got trapped. Long-term holders suddenly questioned themselves. Dip buyers went silent. That silence is often where opportunity quietly forms, not because prices must rise immediately, but because excess emotion has been drained. If you want a framework that actually works, remember this. Gold is the macro signal. Silver is the amplifier. Gold reflects how the world feels about money itself. Silver reflects how intensely the world reacts to that feeling. When you forget that distinction, you expect silver to behave politely and gold to behave explosively. Both expectations lead to frustration. Over the last couple of weeks, nearly everything has been shaking. Metals, equities, digital assets, even instruments that are supposed to be dull. This is the kind of environment where one headline can hijack your thinking if you let it. But zoom out and something less dramatic appears. Gold and silver are still outperforming the major U.S. equity indexes on a year-to-date basis. Not every day, not every hour, but on the scoreboard that actually compounds. The same pattern existed last year as well. Silver in particular has been erratic, overshooting in both directions, behaving like it's permanently caffeinated. That doesn't invalidate its role, it defines it. If you judge your entire strategy based on one violent candle, you're letting a single frame of a film decide the ending. So here's what we're going to do. First, understand what actually happened during this pullback and why the dominant explanation only covers part of the picture. Second, look at what the market is signaling underneath the noise, both technically and fundamentally, and why that matters for timing. Third, map out the realistic paths forward for gold and silver, including the uncomfortable versions most people avoid. There is also a specific silver issue approaching that could become a headline quickly, and when it does, most people will misunderstand it. We'll get there. Before any of that works, we need to fix a common mindset error. When people say metals are down, they usually mean down from a recent high they were emotionally anchored to. That's not analysis, that's comparison bias. A better question is down compared to what? Compared to cash that quietly lost purchasing power, compared to expenses that kept creeping higher, compared to alternatives that felt safe but delivered less. Cash doesn't scream when it loses value. It erodes politely, like a slow leak you don't notice until stability disappears. When you look at metals through that lens, pullbacks stop looking like betrayal and start looking like what bull markets actually do. They test conviction. They see who drops the position. That leads to an uncomfortable but necessary question. If you weren't holding metals, what were you going to hold instead? Most people don't consciously choose between gold and stocks. They choose between gold and doing nothing, between silver and cash, sitting still. Calm is not the same as safe. Safety is purchasing power. Safety is flexibility. Safety is not being forced to sell when conditions tighten. If groceries cost more, that's arithmetic. If insurance costs more, that's accounting. If rent rises, that's contractual. This is why metals continue to attract buyers, even after sharp pullbacks. Not because everyone suddenly became enthusiastic, but because people are trying to store effort. Money is stored effort. When stored effort is diluted, people search for containers that leak less. Gold has filled that role for centuries. Silver can too, but it behaves differently. That doesn't mean every dip should be bought blindly. Sometimes a dip is just a dip, sometimes it's a trap. Structure matters, signals matter, a plan matters. Before charts, there's another topic that always appears: the dollar. Yes, the dollar matters. A stronger dollar can pressure metals. A weaker dollar can relieve them. But the dollar is also a sentiment gauge, not a medical diagnosis. It can bounce because positioning got crowded, because month-end flows hit, because risk aversion spiked. A bounce does not end a cycle. When someone says the dollar bounced, therefore metals are finished, that's like saying it rained today, therefore summer is canceled. Cycles don't work that way. The same voices claiming perfect foresight over currencies often struggle to predict their own expenses. You'll also hear that central banks are about to turn permanently tougher, liquidity will vanish, and metals must collapse. That story ignores constraints, debt loads, refinancing pressure, political sensitivity. Systems don't tolerate high real rates indefinitely. Tough language can coexist with eventual easing. Markets price both at the same time, which brings us back to the recent catalyst narrative. The market latched onto speculation about leadership and treated it like gravity changed. The dollar steadied. Metals wobbled, commentary exploded. Could that narrative act as a spark? Yes, but sparks only matter when positioning is already stretched. This was a crowded trade meeting, thin liquidity with a convenient explanation attached afterward. That doesn't make metals broken, it makes them alive. And active markets always try to shake you loose before rewarding patience. To understand what comes next, we need to finish the gold picture properly, because silver only makes sense once gold's behavior is understood. Gold doesn't announce turning points loudly. It communicates through restraint. After the sharp drop and rebound, gold didn't unravel. That matters more than most people realize. Markets that are genuinely breaking do not hesitate. They slide, bounce weakly, and then continue lower with little resistance. That's not what we saw. What we saw was pressure, followed by absorption, followed by hesitation. That sequence tells you demand exists even when confidence wavers. Pullbacks inside larger uptrends usually follow a rhythm. First comes the emotional flush, where leverage is forced out and weak positioning is exposed. Then comes a bounce that many dismiss as temporary relief. After that, price often drifts sideways in a range that frustrates both optimism and pessimism. This is the phase where attention fades and arguments multiply. That frustration is not accidental. It's how markets reset without collapsing. One of the most reliable tells during this phase is what happens after the initial panic. The first sell-off is emotional. The second test is structural. If price fails to extend lower decisively on the second attempt, it suggests selling pressure is being absorbed. That pattern has been visible recently. Each push lower has encountered buyers sooner than expected. Long lower shadows on daily candles aren't forecasts, but they are evidence. Sellers tried to press. Buyers stepped in. That doesn't promise immediate upside, but it weakens the bearish case. Another layer that often gets overlooked is closing behavior. Intraday volatility can be violent and misleading. Closing prices reflect decisions rather than reactions. When gold repeatedly closes away from session lows during volatile periods, it suggests underlying demand is present even when fear spikes. That's not typical behavior at the start of sustained downtrends, which tend to close heavy and unresolved. Zooming out to a weekly perspective reinforces this view. Gold remains within a broader rising structure that has survived multiple tests. Weekly trends do not reverse quietly. They require sustained pressure over time. So far, that pressure has not appeared. What we've seen looks more like consolidation after a strong advance. This is why constant monitoring of short-term price action can be counterproductive. Human psychology isn't built to process continuous valuation updates. It creates urgency where patience is required. That doesn't mean downside is impossible. Markets revisit pain points deliberately. Retests challenge confidence. They force participants to confront their reasoning. If your thesis requires price to behave politely, it's not a thesis, it's a hope. Healthy positioning assumes discomfort. It allows for multiple outcomes without emotional collapse. This brings us to silver, where discomfort is magnified. Silver is not simply a smaller version of gold. It is a different instrument with overlapping but distinct forces. Silver carries monetary sensitivity and industrial dependence simultaneously. That dual identity creates instability. When fear rises, gold often attracts capital first. Silver can lag. When confidence returns and industrial demand remains firm, silver often accelerates sharply. This lag, then surge behavior, is why silver feels punishing during pullbacks and euphoric during rallies. Technically, silver has been less orderly than gold. It has not reclaimed structural references as cleanly. That does not automatically imply weakness. It implies volatility. Silver rarely consolidates neatly. It overshoots, retraces, and tests conviction repeatedly. Expecting calm behavior from silver is a misunderstanding of its nature. This is where position sizing becomes critical. Silver does not forgive oversized exposure. It turns volatility into emotional decision-making. Smaller stage positioning allows you to remain rational while silver behaves irrationally. That difference determines whether volatility becomes opportunity or threat. Beneath price behavior, silver's demand profile continues to evolve. Global electricity usage continues to expand. Data infrastructure growth remains persistent. Electrification remains a long-term trend. Silver has substitutes in certain applications, but substitution is neither instant nor frictionless. Industry adapts slowly. These structural demands do not vanish during market pullbacks. On the supply side, silver production does not respond rapidly to price. A significant portion of silver supply is produced as a byproduct of other mining operations. Even if silver prices rise dramatically, output does not immediately surge. That lag creates sensitivity during periods of rising demand or logistical stress. This brings us to the topic many discuss, but few explain carefully: futures delivery. The narrative circulating suggests that upcoming delivery windows could expose strain within the system. Like most market narratives, this one contains both truth and exaggeration. Futures markets are primarily financial instruments. Most contracts are closed, rolled, or settled without physical exchange. That is normal behavior. The critical variable is participation. How many contract holders actually choose to stand for delivery? That number varies based on incentives, stress, and physical demand. If that participation rate rises meaningfully, pressure can emerge, even if metal exists globally. Delivery is not about total supply. It is about availability in the correct form, location, and time frame. Imagine a scenario where a higher than usual percentage of contracts stand for delivery. Not a majority, but enough to matter. Vault withdrawals increase. Logistics become more complex. Even if delivery ultimately occurs, the process itself introduces tension. That tension does not require a public failure to affect price. Silver is particularly sensitive to these dynamics because industrial consumers cannot simply wait. Manufacturing processes depend on continuity. If certain channels tighten, price responses can be swift even if overall supply remains adequate. This is why claims of total shortages miss the point. Markets break at the margin, not in absolute terms. At the same time, skepticism is necessary. Delivery stress narratives are frequently used to create urgency. Urgency generates emotional decision-making. Not every delivery window produces disruption. Many resolve quietly through incentives and adjustments. Large participants often negotiate behind closed doors. The absence of drama does not imply absence of stress. Another factor amplifying silver volatility is liquidity timing. Silver pricing is influenced heavily by overseas participation. When major markets pause for holidays or seasonal breaks, liquidity thins. Thin liquidity exaggerates moves. Stops are triggered more easily. Levels are pierced without follow-through. These moves are often misinterpreted as structural signals when they are largely mechanical. Technically, silver remains conflicted. It has not yet confirmed a clean transition back into trend mode. That does not preclude it. It simply means the path may involve sharper swings and more frustration. Silver often demands emotional endurance before delivering financial reward. This is why drawdown tolerance matters. Could silver revisit lower support zones before stabilizing? Yes, silver is capable of moves that feel unjust. That possibility does not invalidate a bullish thesis. It reinforces the need for disciplined execution. Staged accumulation reduces regret and preserves flexibility. One more layer often misunderstood is inventory classification. Not all silver is equal in market mechanics. Some inventory is deliverable, some is not. Some is technically eligible but practically unavailable due to ownership or pricing preferences. The critical factor is the marginal ounce, the ounce that must be sourced without triggering broader repricing. When that ounce becomes scarce, stress emerges. Exchanges possess tools to manage stress: incentives, cash premiums, roll encouragements, and alternative settlement mechanisms. These tools can prevent public failures while still reflecting tight conditions. Stress often shows up subtly before it appears in headlines. Key signals include near-term contracts trading above longer-dated ones, rising lease rates, persistent physical premiums during paper weakness, and declining inventories in relevant categories. These signals precede major moves. Watching price alone leaves you reactive. Silver is being influenced by multiple forces simultaneously: industrial demand, investment demand, emerging market savings behavior, supply constraints. This combination does not guarantee immediate upside, it guarantees sensitivity. When alignment occurs, silver moves rapidly. If upcoming delivery periods pass quietly, frustration will dominate sentiment. That frustration can strengthen the base. If stress emerges, volatility will increase sharply. Both outcomes can occur within the same period. Calm mornings can turn into chaotic sessions without warning. The mistake many make is equating discomfort with failure. Silver frequently feels worse before improving. This does not mean ignoring risk. It means respecting volatility rather than fearing it. Decide your horizon, decide your size, decide your plan. Silver does not reward improvisation. It rewards preparation. And preparation requires accepting that uncertainty is part of the process, not a flaw in it. Now we bring everything together, because this is where most people lose clarity. They fixate on individual events instead of systems. They react to headlines instead of structure. And they confuse activity with progress. Markets rarely reward that behavior. What they tend to reward is preparation combined with patience. Gold and silver right now are not asking you to predict the future. They are asking you to understand probabilities and remain composed while uncertainty does its work. Let's start with gold, because gold sets the tone. The most likely path forward is not dramatic, it is consolidation. Sideways, frustrating movement that drains excitement and attention. This phase irritates both bulls and bears. Optimists grow impatient, waiting for new highs. Pessimists grow frustrated, waiting for breakdowns that never fully arrive. That irritation is not wasted time. It is the market resetting expectations and redistributing exposure. Gold often resolves from these ranges without warning. The move usually begins quietly, after boredom replaces fear. It does not wait for consensus. It waits for positioning to thin enough that movement can occur without resistance. That is why attempts to time gold based on news often fail. By the time the explanation arrives, price has already moved. The forces that have supported gold over the last several years have not disappeared. Debt levels remain elevated. Refinancing pressure persists. Fiscal discipline remains questionable. Confidence in long-term purchasing power continues to erode gradually, not catastrophically, but persistently. Gold does not respond to panic alone. It responds to doubt that lingers. One of the most important structural factors in gold's favor has been consistent institutional demand. Central banks do not chase momentum. They accumulate gradually, often on weakness. That behavior does not eliminate volatility, but it creates absorption zones. When dips attract steady buying rather than panic selling, downside becomes contained. This changes the character of pullbacks. That does not mean gold will move in a straight line. Pullbacks remain part of the process. Retests remain possible. But structurally, gold remains in a position where consolidation strengthens the foundation rather than undermining it. Time works in favor of trends that are supported by long-term imbalances. Now let's talk honestly about timelines, because this is where unrealistic expectations cause damage. Markets do not move on schedules. They move when pressure exceeds tolerance. Gold could remain range-bound for weeks or months before challenging highs again. That does not indicate failure, it indicates digestion. Those who require constant confirmation tend to exit during these phases, only to re-enter later at worse prices. Silver, by contrast, does not digest quietly. It rarely grants emotional comfort. Silver's path forward remains bifurcated. One path involves stabilization, gradual accumulation, and an eventual turn higher as demand and stress align. The other path involves one more violent shakeout during a thin liquidity window, followed by a sharp reversal that catches most participants off guard. Both paths remain plausible. What determines which path unfolds is not prediction. It is participation. How positioning evolves, how liquidity behaves, how marginal demand interacts with supply constraints. Silver responds to pressure points, not narratives. When enough pressure accumulates, price moves rapidly. Until then, silver tests patience. This is why silver requires different expectations than gold. Silver often feels broken just before it improves. It often punishes emotional conviction before rewarding disciplined exposure. This is not a flaw. It is its nature. Those who treat silver as a calm hedge often abandon it at the wrong time. Those who treat it as a controlled allocation survive its volatility. Delivery mechanics remain one of silver's most misunderstood elements. Stress does not need to manifest as failure to matter. Tightness can appear through premiums, incentives, and logistical adjustments long before headlines emerge. Markets react to marginal stress, not dramatic collapse. Waiting for visible crisis is how opportunity is missed. At the same time, restraint is necessary. Not every delivery window produces disruption. Many resolve quietly. Institutions adjust behind the scenes. The absence of drama does not negate the presence of pressure. It simply means the system adapted. Understanding this distinction prevents emotional overreaction. Silver's sensitivity is amplified by its unique demand profile. Industrial usage does not pause during market volatility. Electrification, data infrastructure, and manufacturing continue regardless of sentiment. Supply response remains constrained by structural factors. This combination creates latent tension. When investment demand overlaps with industrial demand, silver moves aggressively. But aggressive movement cuts both ways. Silver can overshoot downward during liquidity vacuums just as easily as it can overshoot upward during stress. This is why position sizing matters more than prediction. Those who size correctly can endure volatility. Those who oversize are forced to react. Risk management is not about avoiding drawdowns. It is about surviving them. Every market participant experiences drawdowns. The difference lies in preparation. Time horizon determines whether volatility is enemy or ally. Short horizons magnify fear. Long horizons absorb it. Entry strategy also determines outcome. All-in approaches create emotional attachment. Scaling allows flexibility. Scaling accepts uncertainty rather than denying it. This is not weakness. It is realism. Markets reward realism more often than bravado. Exit planning is equally important, even for long-term exposure. What constitutes success? A price level, a purchasing power goal, portfolio balance. Without a predefined answer, emotion fills the gap, and emotion makes poor decisions under pressure. Gold and silver should not be viewed in isolation. They interact with broader risk dynamics. Equity instability drives diversification. Digital asset volatility increases demand for tangible alternatives. Credit stress elevates hedging behavior. Metals sit at the intersection of these flows. They are imperfect, but they are independent in ways many assets are not. In a world increasingly reliant on leverage and digital abstraction, tangible assets regain relevance during stress cycles. This relevance does not arrive smoothly. It arrives in waves, often after periods of frustration. Those who mistake frustration for failure exit too early. For newer participants, volatility is part of the education. No market offers reward without discomfort. For experienced participants, humility remains essential. Familiarity breeds complacency, and markets punish complacency without hesitation. Returning to the original narrative, the idea that this entire pullback was driven by a single personality or headline is simplistic. What we witnessed was a crowded positioning environment encountering liquidity constraints with a convenient explanation applied afterward. That interpretation fits market behavior far better than the popular story. This does not imply metals are finished, it implies they are active. Active markets test participants. They force reevaluation. They remove excess. Passive markets quietly erode value. Given the choice, activity is preferable, even when uncomfortable. Here is a simple dividing line between those who survive cycles and those who do not. Can you tolerate periods where nothing seems to happen? Can you endure pullbacks without needing to act? Can you add exposure calmly when sentiment is poor rather than euphoric? These traits are not exciting, but they are rare. Gold rewards patience. Silver rewards resilience. Neither rewards panic. Both punish emotional decision-making. The market does not require brilliance. It requires discipline. The next decisive move, whenever it comes, will surprise most participants. It always does. That surprise is not random. It is the result of positioning, expectation, and emotion becoming misaligned. Those prepared for multiple outcomes benefit. Those anchored to a single narrative struggle. We are not at the end of a story. We are in the middle of one. Pullbacks are chapters, not conclusions. Understanding the difference changes behavior, and behavior determines outcome far more often than prediction. Stay structured. Stay appropriately sized. Allow uncertainty to exist without forcing resolution. That is how probabilities work in your favor over time.